Hello, welcome to Russell Investments Market Week in Review for the week ending June 7th, 2024. I'm Zoe Wargantz, and I'll be your host. Today, I am joined by Shay Shatria, Director of Investment Strategy. Hi, Shay. How are you?
I'm good. How are you, Zoe?
Happy to have the sun out in Seattle. That's how I'm doing. So, a lot of activity this week, starting particularly with central banks. What kind of outcomes did we see, and how did the markets react?
Yeah, for sure. It has been an interesting week, and we've actually seen quite a bit of movement in interest rates once again. It's kind of been the theme throughout the year where we've seen a fair bit of market volatility or interest rate volatility, I should say. And this time around, we've seen a downshift in yields this week, and part of that is due to central bank activity, we believe. So both the European Central Bank as well as the Bank of Canada had interest rate decisions this week, and they both cut by 25 basis points. Now, this is the first rate cut for both of these central banks in this rate cycle. If you will, the ECB rate now, their deposit rate is at 3.75% versus the Bank of Canada. Their policy rate is at 4.75%. Now, just to keep in mind, it's just the initial rate cut, so both rates are still very restrictive. And, based on the messaging that both central banks have communicated, they're both, of course, messaging data dependency, right? There isn't a predetermined path, but crucial will be, disinflation trends going forward. And if the disinflation trend does progress as the central banks expect, then we should see further rate cuts over the course of this year. Now, the markets are pricing about 1 to 2 rate cuts for the European Central Bank. For the Bank of Canada, the markets are pricing about 2 rate cuts by the end of this year. We think that slightly more is possible than what the markets are pricing, but of course, a lot of that will be data dependent and, of course, is influenced by inflation trends continuing to cooperate as we expect it would.
All right, excellent. It feels like every time I'm on this show, we are talking about inflation. So it's nice to hear that there's some movement after all. So we've covered Canada and Europe. How about we move over to the US? How are the economic data looking right now? I know we've got some interesting stuff coming out tomorrow, but what are our expectations?
For sure, and we talk about interest rates and the downshift that we've seen so far this week. But it is really the U.S. economy, its labor market, and Fed expectations that drive. That's a key driver for global rates, right? And it's been the case so far this year, where in the beginning of the year, where we had a situation where the U.S. economy, as well as inflation, was much stronger than it expected, and we saw yields rise over the first, call it 3 to 4 months of the year. But more recently, over the last month or so, we have seen a bit of a moderation. So not a collapse by any means, but just a moderation from really strong levels in terms of growth in the U.S. And we've seen yields generally been moving lower since, call it, mid to late April, as a result of the moderation in U.S. economic growth trends. Now, of course, what will be really critical this week is the non-farm payrolls report, and that gets released on Friday. We are recording this on Thursday, so we don't have that crucial bit of information. But what we can do is maybe provide just some broader observations based on the JOLTS report, of the job openings and labor turnover survey that was released this week for the month of April, which gives us a good idea in terms of just assessing overall supply and demand balance between for the labor market. And what we've seen there is one of the key measures that the Fed and market participants have been keeping an eye on is that job openings to unemployed ratio. And that ratio at peak labor market tightness, if you will, back in earlier in 2022, it was around 2. So 2 openings for 1 unemployed. That's come back quite dramatically, and it's now around 1.2, and that's roughly where that ratio was prior to the pandemic. So we've seen a considerable progress in terms of the rebalancing of the labor market. But what's important to note is that we've seen this level of rebalancing without any job losses, which is almost unprecedented. So a nice rebalancing of the labor market has occurred over the last many months, which has been clearly encouraging for the overall U.S. economy. Of course, the Friday non-farm payroll report will be an important data point, which will influence, of course, the Fed outlook, and of course, potentially contribute to interest rate volatility. The consensus is looking for about 185,000 job gains. And that number is roughly around what we call the replacement rate, which would keep the unemployment rate steady. Now, the way we kind of see things is if there's a big upside or downside to that relative to that number, that's when we could see the markets move quite a bit, where a significant upside surprise to the labor market, to the job growth numbers, that would perhaps imply that the Fed might need to stay maybe restrictive for a little bit longer. But of course, on the other end, if the job growth number is much softer than expected, then that obviously could imply that the U.S. economy may not be just moderating, but perhaps weaker than what the markets are currently expecting, and that would, of course, inform corporate profitability as well, and could be market moving. So, those are some of the things that we're keeping an eye out for the labor report.
Absolutely. It's all data dependent, right? Shay, thank you, as always, for giving us these insights. Without you, we would be lost. And I certainly would be here hosting this show. So thanks to all of you for joining us. And thanks, Shay, for your insights, as always. Please join us again next week for Market Week in Review.
Hi, I'm Sophie Antel-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.